Good morning, everyone. My name is Aniza Ismail, and today's session is about pricing and decision making. First of all, I would like to give you a brief overview of this topic, and then we move to the presentation. And basically, the concept of pricing is when we talk about pricing and decision making, that is one of the most important managerial decision because they directly involve the company's sales, profitability, market share, and competitive position. So the question arises here is that why managers they use cost and market information to set prices? So the answer to this question is that they want to achieve their long-term goals, long-term or short-term goals, while satisfying the customer. So that is the two things which are going hand in hand with each other. They want to achieve or maximize their profits, plus they want to satisfy their customers' needs. So here the objectives of pricing are basically that they want to maximize profits, they want to increase the sale revenues, they want to gain or maintain the market share. It can be the survival in the competitive market. They want to build a premium, or we can say the value-based brand image. So these are all the factors, or you can say the objectives for the pricing. So now comes the hard part, why it is important for the companies or businesses to use pricing in decision making. For that matter, and for your understanding, I've made a PowerPoint presentation for you, so you'll be able to understand in a more convenient way. I'm going to share my screen with you, and then you'll be able to see what pricing means in the decision making. So here it comes. Well, so this is the pricing in the decision making. Why are we using pricing in decision making? They are the certain things which can actually makes the managers, or we can say the businesses, to indulge in the pricing in decision making. It is not the pricing concept just like the marketing pricing concept, but obviously it's related with the accounting. So there will be the hard numbers behind it, which we are going to discuss. So after today's lecture, you'll be able to understand more about why certain product has allocated certain price. So these are the major pricing methods which we will be discussing today. That is the target costing, cost plus pricing, time and material pricing, and the transfer pricing. So the roadmap of today's agenda, or you can say today's presentation, is basically we'll be covering these four main costs, which is target costing, cost plus pricing, time and material pricing, and the transfer pricing, along with the case study as well, which gives us the practical view of the pricing in decision making. So firstly, we'll be discussing target costing, which is basically the target costing is when we set with the price of the set with the price, which basically the actually we will considering it as a market price, right? So the market gives us the certain price. So it works in a kind of a backward way, or we actually the product is being assigned a certain price from the market point of view. However, in the case of cost plus pricing, we see that there are the certain costs which is to be included in it. First, it will be the unit cost that is to be included. And the second thing which is important in the cost plus pricing is the markup. Markup is the one thing which is to be included in the cost plus pricing. So that makes it a little different from the target costing, because the markup is to be added in it. And it also involves these two approaches as well, which is absorption and the variable approaches. Thirdly, we'll be discussing time and material pricing, which is actually related with the service industries or service providers. Um, it also includes these two factors, which is time, labor time, and materials. So that makes it little different from the other two types. Last type is basically the transfer pricing, and in this we will be discussing how one part of a company sells to another part of the company, part of the same company, and what happens when we use certain outsourcing effects and cross-border transfers, and how it will affect the pricing. And lastly, we'll be discussing or comparing the two firms, which is one is the service provider firm, another one is the manufacturing firm, and we will see how the two costing uh, processes they actually helps these two firms. So the first one is the target costing. So in the case of target costing, we say that from the beginning that the start from the price the market will bear and the engineer the cost to fit. The one thing which I want you all to remember is basically that the price is actually given, right? But the cost is actually engineered. So here's a concept of this target costing, and then you'll be able to understand it more that they sometimes the company they cannot get a freedom to set its own price. So basically they use certain kind of measures, or you can say the benchmarks, like sometimes the competition is there and sometimes there's a customer expectation. So by involving all these factors into price setting, that makes it a little bit different as compared to the other pricing concepts. So the company they must design a product, um, uh, it can actually basically makes the product affordable for the customers, and also they can still gain the profit goal. For that matter, I'll give you an example, and you can see from this formula as well that actually there is a target costing, and it actually subtracts the expected selling price with the desired profit. So when you subtract these two, you'll be getting the total target cost. So in the example, you can see that there is a $120 expected selling price, and the profit margin is 20% for that cost, and that is makes it total $24. And when you subtract these two, you'll be getting $96. So if you actual design cost, for instance, if the actual design cost it exceeds the $96, so obviously the um, you don't want to change the price or raise the price. So obviously you just makes your team to revamp or re-engineer the product or redesign it by looking at into the certain factors like material features and processes, so that you'll understand where um, there is a certain cost issues. So next thing is total cost plus pricing. So we have to start from the cost, but we have to add a markup to each reach the selling price. So in this case, total cost plus pricing, we see that there is a um, certain flip as compared to the target costing. Here we are actually including the markup. Um, as you can see from the formula that total unit cost by total unit cost plus markup, that makes the total selling price. So total cost plus pricing equals to total unit cost plus markup. So when you have we can see that if there is a total unit cost of $50 and there is a markup of 40%, so that makes the $20 price. So when you add up these two, you'll be getting $70. So that is the selling price which the customers have to pay for a certain product. But there are certain limitations to this total cost plus pricing we see here is that number one, it ignores what customers are willing to pay. Secondly, it ignores what competition is actually present in the market. Sometimes it ignores that as well. That the competition or the competitors are charging something different, so they are just ignore it simply. And thirdly, if there is certain, you can say the circular logic problem kind of a thing, which is actually your unit cost depends on how many units you actually produce, but it's basically, but how many you sell depends on your price. So that is the bit of a trap here. You can see that to keep that limitation in mind, it is very important to know that these factors can also create certain issues for the costing process. For that, you will be able to understand more how to overcome that trap kind of a issue, that is absorption versus variable cost plus pricing. You see there are two methods related to that. One is absorption cost plus pricing and the other is variable cost plus pricing. The only difference in these two is the cost base. You can see in the case of absorption there is a variable plus fixed manufacturing cost, while in the case of variable cost plus pricing there is only the variable cost which is to be used as a cost base. So that is the differentiation in these two. Basically, in the case of absorption cost, it includes all the cost, which is including selling, administrative cost, and other manufacturing, fixed manufacturing costs as well. So in the case of variable cost, we see there is a markup which is to be considered as the all fixed cost plus desired profit. So it is basic, variable cost is best to be used in the short-term decision making, like special orders or to evaluate the idle capacity, while the absorption cost is used for the regulation of the pricing or certain gap-based reporting, etc. So another thing is time and material pricing. So the time and material pricing is very much common in service industries like repair shops, consultants, contractors, and law firms. So basically, when we talk about time and material pricing, so the two important things which are to be used here is one is the labor time and other one is the material charge. So you will be able to understand it more when we use this example of auto repair service. That is a 3 hours labor at the rate of $45 per hour, which makes the total cost of $135. While when we include the parts cost and material loading cost, that makes it $80 and the $20. When we add up all of these, we'll be getting the $235 total invoice. So that is the time and material pricing. When we talk about transfer pricing, we see that the transfer pricing is when it's mostly called as internal pricing, right? So when one division it sells the goods to or services to another division of the same company, we say that there is a transfer pricing. So it is basically happening within one company. So in a decentralized companies, basically decentralized companies are the companies where decision making is mostly happen at the lower level of the management. So means every division has their own decision makers, so they can make their own decisions. So as you can see from this example that if the division A is selling or giving product to division B, so basically division A is supplying the product while the division B is receiving the product. So division B is at the cost side while the division A is at the revenue side. So these are the major transfer pricing explanation. What are the approaches which are to be used in the transfer pricing? These are three ways which can be used to set the internal price. Number one is the negotiated price. Number two is cost-based price. Number three is market-based price. When we talk about negotiated price, so obviously the two division, they negotiate with each other. If they are independent companies, it can actually preserves the autonomy and works best when there is a market price to use as a benchmark. So what about cost-based pricing? When we talk about cost-based pricing, it actually includes the transfer price, which is to be set at the supplying division's cost, that is variable, full, or cost plus. So these are the Simply, we can say that it can sometimes hide the inefficiencies and to remove the incentives to control the costs. While we talk about market-based price, when market-based price is basically when we include the transfer price equals the price to the goods which would be fetched in an outside market. So mostly the competitive external markets, they actually uh, exist for that product. So what are the certain complications in the transfer pricing? There's two main complication or situation which can change the transfer pricing concept. That is the outsourcing, and number two is the cross country or cross border transfers. When we talk about outsourcing on the transfer pricing, we can see that outsourcing is sometimes an outside supplier. It is providing the component or the product at the cheaper rate. So the buying division, it is they're actually buying in division. They have the incentive to buy it internally. So the buy it internally, they actually um, drop. So the supplying division may have to match the outside. Um, you can say match the outside price or to lose the sales entirely. So that is how the outsourcing happens. But in the case of cross-border, or we can say transfer prices. So in that way, we see there is a corporate tax, income tax rates, which are differing in the different companies or different countries. They set the prices to shift more profit into low tax jurisdictions. So certain tariffs or duties are being uh, included in it. So that is actually affecting the cross-border shipments. So certain guidelines have to be followed by OECD, which creates the arm's length to prevent the artificial profit shifting and how freely the price can be set. So these are the complication which can actually affect the transfer pricing. Now comes the case study, or we can say the real world example, in which there are two firms which are to be used. One is the consulting firm, another one is the furniture manufacturer firms, and they are setting the price. We see how they are going to use certain prices or pricing methods in their firms. Number one is the consulting firm, which is a service provider firms. We see they're using time and material pricing. How they are using time and material pricing? Because in this consulting firms, they are actually mid-size management consulting firm. They actually bills the clients by consultant consultancy hours, and they charge for materials like reports and travel software licenses, etc. So, in simpler way, we can say if there are two partners and one is um, um, actually charging $250 per hour, and he is actually given 10 hours of services, so that makes almost $2,500. While his associate, he's giving more hours as compared to that, so it's giving 40 hours with a rate slightly lower than the 250, so it's giving $95 per hour. So that makes the $3,800. So when materials and loading cost is to be added, so that makes the $690. When the total invoice is to be created for that, so that is the $6,990. So the question arises here is that why time and material fits here. There are certain key points here. That one thing is that the output is intangible, and it is very likely that the highly variable per client engagement or the concept of unit pricing, which is to be used in the other cost prices, it's not applicable here. While the clients, they use hourly kind of a bill because the effort is quite visible and auditable in timesheets. So senior partners, the hours are billed at a higher rate than the junior associate hours. So that also reflect the expertise levels as well. While the material loading covers overhead cost and the other profits as well, like office space and administrative support as well. In the case of furniture manufacturer, we see they are using target costing plus absorption cost method. And basically, it's a retail market and retail market um, manufacturers. So basically, furniture manufacturers, they are competing in a retail markets, and they um, work best from backward from price. So that verifies with the cost plus. So when we see the retail prices, the market have set that is $450 and desired profit margin is 22%. That is $99. Target production cost is $351. Actual production cost is $338. So they have actually used this kind of a concept here. So if the design cost it exceeds the target material or process, then they are basically they are actually redesigned rather than raising prices. We have already studied about it. They will be there is no need to raise the price um, efficiently, but they actually redesigned it or try to make some changes in their processes or materials rather than fluctuating their prices. So the core differences in their consulting and the manufacturing firm are these. So these are the takeaways, or you can say that is how we can actually mirror how value is actually created and measured in the business, and how certain hours of services engineered cost for certain standardized products. As we see here in the consulting firms or services, there is a labor time plus expertise, while there is a market price point in the manufacturer firms. Pricing methods are different in these two. Time and material is used here in service, and target costing is in furniture. Cost visibility is per hour, but here we see there is a per unit standardized cost. So flexibility is high in the case of consulting firm, while there is a low flexibility in the furniture manufacturers. So the key takeaways for today's lectures are basically these 4 points. As we see in the target costing, it works backward from the market price. That is, the cost is engineered to fit, not the reverse. While in the case of cost plus methods, it differ by the cost base, that is total absorption or variable. Each one is suited for their own different kind of a decisions. So time and material pricing, it fits service businesses where labor and materials are the visible cost drivers, while the transfer prices, it balances the performance measurement against overall company's profit, and it sometimes it complicates the outsourcing option and cross-border tax rules. So that is how the whole lecture takeaway was. So these are the 4 main takeaways for today's lecture. The reference material for the today's presentation is from this book, that is Managerial Accounting Tools for Business Decision Making by Wingate and J.J. Kimmel 2021. So if you want to consult this book, you can buy it because it's not available on the internet. Um, Otherwise, you have any kind of a queries or question, you can freely ask me. That is the whole lecture for today's class. Thank you so much for your time. Bye.